Hello, everyone, and welcome to our Navigating Banking Uncertainty webinar. We're super excited that you're here. Um, we're going to be waiting a couple minutes while we wait for everybody to get settled in before starting. Let me admit the panelist really quick. But in the meantime, let us know where you're joining us. Are you from the Boston area? And how did you hear about this webinar? We're super excited that you're here.
Hi, how are you? So it seems like Apea has issues with the link. Let
Oh,
me
mhm.
forward him what I just got from the Boston admin to see if he can
No
use
worries.
it. One moment. Sorry about that. Technical problems today.
Awesome.
I'm gonna turn the light off 1 second.
Hello, everyone. Welcome to the webinar. For those of you who are just joining us, we're still getting set up, but we're super excited that you're here. In the meantime, let us know in the chat where you're coming from and where you came and where you hear about the event. I see that Chaya, I'm hoping uh, I'm pronouncing your name right. She's from State Street, Boston. So hello.
Hello, hello. So maybe Apea, do you wanna click on on the right corner of my name, which is your name, because I say you on my link, and then you can probably modify it to say your name.
Oh, am I coming up as you, am I?
Yeah, yeah. Because I forwarded you my link because you couldn't locate yours, so we can be Anthony. It's okay. But I
All
think
right.
if you click um on your name or something, you're able to change it. Like on the participant list, I guess you can change, modify it to be you.
All right, I'll try and do that.
You can you open the participant panel. I think you can click on it or something. That's normally how it works, right?
Yeah, you should be able to click on your own name. Let me see.
There you go.
Yeah, and then you can rename it to yourself. We made it. We're here.
Yeah, awesome. Yeah, I see the
That
change.
work?
So yes,
Awesome.
perfect. We're on.
Okay, awesome. So let's kickstart the panel. Welcome everybody again. We're so happy to be joining us today. My name is Oscar, and I'm the Associate Director of Marketing at Alpha Boston. And here we have my fellow board member, Anthony Almanzar. He is the Director of Financial Literacy at Alpha Boston, but he is also the Vice President and Program Manager at State Street Global Advisor. A bit about Anthony. He joined State Street in 2015 as an information security risk analyst, and now as a program manager, he's responsible for driving, planning, and governance of prioritized technology deliverables across multiple applications in support of new commercial and business growth mandates. Um, Besides his job, Anthony is very involved in the community, serving in multiple professional associations and as an advisor in different board members around the Boston and around the Boston area. So thank you so much, Anthony, for being here today.
Thank you. Thanks for the intro, Oscar, and it's my pleasure to be here today with you guys. You know, this inaugural event as the this newly appointed position as the director of financial literacy for Alpha Boston. I've been a member of Alpha for a number of years, and supported ALPFA for a number of years as well at different capacities. I'm happy to be here today, joined by my colleague Apea Amoa, and today to sort of celebrate Financial Literacy Month. We're going to be talking about a particular topic that is pretty relevant, to the things that are have been happening, particularly during the last month, right, around the banking. So, last month there have been, reports of bank problems right and left, with bank runs, government takeover, devaluated merger and acquisition activities at final events, and it's happening, in several parts of the world. It's not only a U.S. problem. Um, and normally a bank run occurs when depositors rush to withdraw their funds from a bank. So let's say everybody decided today to just go to the bank and get all the money back, right? So that usually when that happens, that leads to depletion of the bank reserves, and potentially it causes the banks to fail, because the banks need your money to operate, right? And if everybody goes in and asks for their money back, they won't have any money left. So that's what happened to Silicon Valley Bank, First Republic Bank, and Credit Suisse. So this bank have raised concerns about the stability of financial markets and the impact of government policy on these markets. So today, we're meeting with Apea to just do a debrief about these recent events, right? And essentially, try to understand a little bit more, like, how did this happen, why did this happen, and like what are his sort of views on this, on his personal perspective, right? So just to be clear, we are not here to provide you personal finance advice or to provide you investment advice or asset management advice, right? We don't have this is not the right forum, or we don't have the right licensing or permission to do so. We're just going to have a friendly conversation to really debrief and understand what happened. And just to understand, why this happened, what are some of the regulatory impacts, right? Because there are always regulatory actions after similar things happen. Like over the years, you've seen it. Every time there is a major disaster, there's a new regulation that comes out of it. So just like really having that kind of conversation, so we can really understand what's going on right now in the market. So I'm very excited to be joined today by my colleague Apea Amoa. He is a senior vice president and the chief financial officer for State Street Global Advisor, which is where I work. State Street Global Advisor is the fourth largest asset manager in the world. Apea is responsible for the development and execution of the financial strategy for global advisors. Apea defines and delivers the overall financial approach for global advisors, including financial forecasting, management reporting, investment tracking, and pricing. Additionally, he is responsible for communicating and driving the global business priorities to deliver better financial results. In this role, he also drives continuous improvement to financial analytics and productivity. Apea has over 20 years of experience in accounting, audit, and finance, and has held a number of roles at consulting companies like Deloitte, Arthur Andersen, and also at Morgan Stanley. He is a fellow member of the Institute of Chartered Accountants in England and Wales. So, he's, I guess, originally from that, from Europe, right? So, I'm very thrilled to welcome Apea today and discuss with us. Hello, Apea.
Hey, Anthony. I'm very thrilled to be here. Thank you very much for inviting me, Oscar, and the rest of the Alpha group. I'm hoping that we have a very interactive, informative conversation today. So we're very much looking forward to this.
Thank you so much. So let's get started with the first question today, just to start having that discussion. So, as I mentioned earlier, and of course, there were several crises of different banks happening here in the U.S. And some outside of the U.S. So, what events or factor contributed to this recent banking crisis? Like, what can you share with us that?
Yeah. So absolutely. So before I actually get into that, so I teed up a couple of polling questions just to get some interaction going. So Oscar, I don't know if you have them ready. Maybe I can ask the audience the first question and let's see what the responses are.
Yeah.
So
Sure.
So like Anthony said, we're talking about banking. So first question for you guys: how many banks do you think there are in the U.S. right now? So you can see on the screen, 0 to 500, 1,000, 2,000, 2,000, 3,000, 3,000 to 4,000 or over 4,000. Really intrigued to get a sense of how many banks you think there are in the US.
I'm curious to know how many that we have. I have no idea.
We're almost
So,
there. We're just waiting a couple people to finish replying.
so how many people do we have in the audience, Oscar?
Today, so far we have 23 people in the audience today.
Okay, great. And can you post the results now?
Yes.
Go.
Should be getting it now.
All right. Okay. So we had, 26% of the people thought we had over 4,000 banks. Yeah. I mean, you guys, and then 26% thought 2,000, 3,000. So the actual answer is 4,800. We have about 4,800 banks in the US right now. And if you flip back to 2007, when we had the last banking crisis, we had over 7,000 banks in the US. So, quite a lot of banks in the US, right? All right, let's go to the next question. So how many banks failed between 2008 and 2010? So this is the last banking crisis, the great financial crisis. How many banks do you think failed between 2008 and 2010? So Oscar, if you can flash up the next poll.
You should be seeing it now.
So between 0 and 10 banks, 11 to 50, 100 to 300, over 300 in the last financial crisis.
Here we got the results now. Here we go.
All right, let's have a look.
Let me know if you can see it.
Not yet. Oh, can you see it, Anthony? I can't see it.
I was able to see it, yeah. So we have 50% of the answer was over 300.
Well, yeah, you guys are with it. You guys are definitely on it. Okay, so you're clearly well informed, know what's going on. So it was about 322 banks that failed. And as you know, obviously we're talking about the events of the last, couple of months. It's really just sort of hot off the press. It's really kind of just started. But so far, we've only had 3 major banks fail in the US, right? So you've had Silicon Valley Bank, you've had Silvergate Bank, and you've had Signature Bank. So really, we've only had 3 so far. You've got others that are in the press, like First Republic's in the press. They just announced some results, a couple of days ago, and they've had issues with their share price, and investors aren't happy with what's going on in that bank. But they're still solvent and they haven't failed. So this time around, we've only had 3 banks fail so far. I just want to kind of size the impact of what's going on now versus what happened in the great financial crisis, where we had hundreds of banks fail, versus what we're seeing now, which is just a handful. Okay. And then the final question before I kind of answer Anthony's question, he might think I'm kind of skirting around this question. I want to answer his question. So the final polling question is, what day of the week do you think most banking failures happen? What day of the week do you think most banking failures happen?
Interesting to know this one.
We're waiting a little bit for everybody to chime in. That's a very unique question. I wouldn't have thought about it at all.
I would think maybe Friday, maybe everybody goes and check their payments or whatever. Like Friday.
I guess. All right. Let me share the results real quick. Let me know if you can see them.
50% Friday.
All right. Yeah, and then again, you're absolutely right. And really, the reason why it happens mostly on Friday, so about 80 to 90% of the banking failures that we've had over the years have happened on a Friday. And the reason why that happens is that typically you'll have the FDIC or another financial institution stepping in to take over a bank on on a Friday, which allows them the weekend. So the markets close. It allows them the weekend to figure out, restructure the bank, figure out their, communication plans, what they're going to do in terms of an orderly transition of the bank's, assets to the new institution, what they're going to do in terms of, protecting the investors and the customers and so forth. And they sort of need the weekend to kind of get all those in place. And then come Monday, they announce the plan, and hopefully that leads to a more orderly transition of the bank's activity to the, either to the government or to a new institution. So Friday is the day that typically most of these things happen. Okay, so now going back to Anthony's question. So we've talked about the last financial crisis, and given the very sort of engaged audience here, I won't go in too much detail in terms of what happened, but I think most of you know that it was really kind of tied to the housing market, right? We had a proliferation of loans that were just banking loans that were issued to people with lower credit scores. I remember back then, banks were offering us, 110% mortgages. People were, taking that extra money and they were going to Las Vegas and they were spending it all. So it wasn't surprising that, we got into the stage where, property prices had been rising for the best part of a decade. And it all came to a head, around 2006. They peaked in the US and everything kind of started crashing down. Banks were significantly exposed to some of these subprime mortgages. So when property prices started coming down, customers started defaulting, they were exposed, right? Some banks started going under, started failing. There was a lot of, misinformation out there. People weren't sure who was exposed. So banks basically just stopped lending to each other. They stopped lending to anybody, right? Which caused a significant acute freeze in capital and liquidity in the market called the credit crunch. And as you know, banks and companies need liquidity to be able to function. And so without that source of funding, that precipitated, a huge bank run, a lockup of capital. And the snowball effect was all those hundreds of banks that ended up failing. Okay. Now, why am I telling you this? Because what the governments did in the US and around the world to kind of step in to stabilize the markets was pretty much this, the platform that's kind of led to some of the issues that we're seeing today. So some of the things that the regulators and governments kind of did to kind of step in to stabilize the markets were, key thing was providing liquidity to the market, because again, without liquidity, companies just can't operate, and banks in particular rely heavily on a good flow of liquidity. They stepped in and actually bailed out some banks. They provided sort of windows where banks could access quick sources of liquidity. They were buying bonds to kind of drive, and that's what we call quantitative easing, drive liquidity in the marketplace. And then one of the key things that they did was they dropped interest rates. So coming into 2007, interest rates in the US were around about 5%. They dropped them pretty much to almost zero. And that's where rates have been for the best part of a decade, right? So, rates started ticking up a little bit in the last few years, but nothing significant, right? Now, Anthony talked about what banks kind of need to, do their business. Ultimately, what a banking model is, banks borrow money from us, right, in the form of deposits. And then what they do is they take those deposits and they lend them out to other people, or they invest it. And the idea is they'll invest it or lend it out to other people and make more interest or more investment returns than what they're having to pay us, right, as customers. And that spread really is their income, and that's what they survive on. So ultimately, what they need to do is, if you think about us as depositors, we can ask for our money back at any point in time, and we have a right to do that, right? So what banks typically do is they try and structure their investments and the loans that they're giving out to their customers in such a way that there is a match of duration, right? So they'll have some, longer term investments, they'll have some shorter term investments, and the banks that do it well, have a good balance so that if they do have what you call a run on the bank, where you have, customers coming in en masse to try and, take their money out, they've got enough sources of capital and liquidity to be able to meet those withdrawals. Okay. And that's what, good asset and liability management, practices allows banks to be able to do. Now, in the case of, Silicon Valley Bank, which is what I'm going to spend a lot of time talking about, that sort of asset liability duration matching wasn't done particularly well. And, in the lead up to, really this year, they never really had to do that. Not even just yet. In the last couple of years, they never really had to do that because interest rates were so low. And what Silicon Valley Bank was doing was with their pools of capital in terms of their investment portfolio, they were investing in, super safe investments. They were investing in US treasuries, right? And that's the US government. I mean, the US government always pays. So, that's a super safe investment. Because interest rates have been so low for such a long time, they were looking for yield, right? So they're looking for, more enhanced investment returns. And to be able to do that, they had to lock their money into longer duration treasuries that ultimately, if you held them to maturity, you would have gotten your money back. But if you're in a situation where you had to sell them, quickly, you could also do that. And with interest rates being stable and low for a long time, that was never an issue because you'd sell it for pretty much the same value as, you invested it in at, because interest rates were stable. The value of those treasuries were pretty much stable. Now, what kind of changed the paradigm was because interest rates have been so low for such a long time. Then COVID happened, right? Now, what COVID did for the whole sort of, marketplace was a couple of things. You had the whole supply chain issue that drove, a freeze up in, supply of goods and services that drove up prices, right? So inflation started ticking up. And that obviously had to be, dealt with, pretty head on. You'd had inflation at, pretty manageable levels around the 1.5% level. And all of a sudden, it skyrocketed to almost 9% in the US. It's obviously ticked down a little bit since then, but it went all the way up to about 9%. And that was a pretty acute thing. And also you had the war in Ukraine, which drove, food and fuel prices up to, record levels as well. And that all added to the whole inflationary pressure that the Fed had to kind of step in and address with a change in monetary policy vis-a-vis hiking up interest rates. Okay. Now, you guys know when interest rates go up, bond prices go down. So this long duration portfolio that as Silicon Valley Bank had, all of a sudden, with interest rates going up, their values dropped. So whereas in the years before that, they didn't have to worry about if they had to kind of sell these investments quickly, that the value would be maintained. All of a sudden, if they had to sell them quickly before maturity, they wouldn't get back the same amount of money as they'd invested. So they had, a valuation issue. So that was one factor. So just keep that in your mind. The other thing that kind of worked itself into this whole issue that we have right now is, COVID was a blessing for, banks like Silicon Valley Bank and the tech sector. As you know, we all kind of shut down and we all went home. Companies had to kind of, invest in new technologies to enable all of us to work from home and, new digital experiences for all of us. And that played well into the tech sector. Now, Silicon Valley Bank obviously was the go-to bank for, venture capital backed, tech startups and their executive teams, right? About half of the clients in Silicon Valley Bank were, tech firms or, their executives, okay? So they benefited during the COVID period when, tech firms were doing really, really well. But post-COVID, that kind of venture capital money dried up. Tech companies aren't doing so well. You've heard about all the layoffs in Google and Facebook and Twitter. So that all that source of capital that Silicon Valley Bank was kind of benefiting from kind of started drying up, and the customers started withdrawing money. So we had deposits leaving that bank, because they had to pay for salaries and expenses and so forth, because all that venture money was drying up, right? So they were drawing on their pools of funds, and their pools of funds were in banks like Silicon Valley Bank. The other issue as well was that you had all these tech executives that had big deposits, and tech companies that had big deposits over $1 million. The average sort of deposit balance over $1 million was quite significant. It was a higher proportion of Silicon Valley Bank than in most places. And as you know, the FDIC guarantees or insures deposits up to $250,000. Okay. So when news started coming out about, Silicon Valley Bank having a bit of a mismatch between the durations of, its deposits and its investments, some of these companies and executives that had their money at the bank started worrying a little bit, because they were thinking, oh, geez, if something happens, a good chunk of my money is not guaranteed. It's not insured. So that again fueled, the withdrawal of deposits from the bank, which actually forced Silicon Valley Bank to actually sell some of its investments at a loss. And then obviously reported it out, to the investment community that it had sold some of its investments at a loss, which further fueled the panic around, the financial stability of the bank. They tried to raise capital in the marketplace that didn't do particularly well. And then that was, the final, nail in the coffin, if you want to call it that. And then we're in an era where, social media it's wonderful, but one thing that it does is information disseminates so quickly, right? So everyone got wind of this, and literally overnight, and literally in one day, we had about $20 billion come out of the bank, and that was really it, right? They just didn't have the capital to be able to support that level of withdrawal, and then the FDIC had to kind of step in, draw a line under it, and wind the bank down. And in Europe, we had, it was, HSBC stepped in to buy the UK operation of Silicon Valley Bank, and in the US, the FDIC kind of took over. So that was the set of events that led to Silicon Valley Bank in particular, shutting down. And the other two banks, sort of Silvergate and Signature Bank, similar things. It wasn't tied to the tech sector per se. It was, but again, it was all about solvency and liquidity. It was their exposure to the crypto market that led to their demise. But same thing, it was a mismatch between, their investments and their depositors, so their assets and their liabilities, right? Their liabilities were coming out faster than their assets could support, which leads to an insolvency situation, and then they have to be shut down. So, Anthony, does that answer the question in terms of what got us here?
Yes, no, thank you so much. It's a lot of background, a lot of good insights and information that I didn't know about, and I guess some of us here on the call as well. And I think that it all happened so quickly. Like when everything started coming out in the news, and we hear about these other banks. So I know it's been a few months, but do you think that there is a risk of contagion from this particular sale? Do you think like other banks will continue down the chain, or like what was your view there?
Yeah, so I don't know if there's still a lot of concern in the marketplace, without a doubt. I mean, a couple of days ago, you had First Republic, which announced its earnings. Its share price fell like by 49%, something like that, on Tuesday, right? Which is a pretty significant drop. And that kind of shows that, the whole banking sector is on watch. Everyone's worried, right? But I don't think it's going to necessarily be a 2007, 2008 type situation where there really was contagion. and it led to a calamitous sort of collapse in the banking sector that lasted for almost the best part of a decade. I don't think we're in that situation because I mean Silicon Valley Bank's issues were actually quite specific and they were quite acute, right? And it was quite a unique set of circumstances that led to Silicon Valley Bank's collapse. But the marketplace is still quite worried about the stability of the banking sector. But I think some of the moves that you know other players in the marketplace, other big banks have kind of done to try and help assure the customer base by investing in some of these banks. Like for example, you heard about a month ago there was a consortium of about 20 big banks that came together to inject about $30 billion into First Republic Bank, right? Which was again a vote of confidence from the banking sector to the banking sector that hey, we're kind of supporting each other and we'll kind of get through this. The FDIC came out. I mean, for Silicon Valley Bank in particular, they guaranteed all the depositors were going to be safe, right? And they'd get their money back. They didn't go as far as doing that for everybody because that'd just be the exposure across the whole banking sector would just be too much for the U.S. government to bear. But in individual cases, they've moved quite swiftly to assure the customer base that hey, we've got you. Okay, so I think with moves like that, there's significantly less panic, in the whole sector than there was, back in 2007, which is a pretty difficult time.
Got it. And then I just realized that not all of us are familiar with banking terms. So can you explain a little bit in simple terms what contagion means, so that way the audience are familiar with the term?
Yeah, so contagion. So I guess it's not just the banking term because that could be used for a sort of virus situation as well. So that's really where you have an issue in one particular pocket spreading like wildfire and impacting a broader set of participants. So in this particular case, contagion would be Silicon Valley Bank fails, and then everyone starts panicking, and it's on all your banks. So you hear that one bank fails, and we all run to our banks and start pulling our money out, and maybe banks that would have been okay and were in much better financial situations would then suffer the same fate as Silicon Valley Bank because that contagion is spread across the broader market space, and we're all kind of queuing up and trying to withdraw our deposits from banks. So it's really the spread of the issue, which might have been isolated to a broader set of market participants. That's what we mean
So
by
it's
contagion.
sort of like a potential byproduct of one bank failing, people freaking out and going all to their banks, and eventually causing
Correct.
the actual customer causing the failures of their prospective banks because everybody's rushing out of panic,
Exactly.
and then eventually they run dry. That makes sense. Thanks for explaining that. Um, Going on, so of course, when things like this happen, there's always a regulatory component. I know like the FIC and some others are. I think there are some regulations that are still being evaluated, but what's your view on sort of new regulations that are sort of being explored to avoid uh, banking to fail, right? I know the part of this was a result of a monetary policy change, right? So what's your view on the regulatory aspect of this?
Yeah. So I'd say, I mean, one thing that we're gonna see for sure. I'd be very surprised if we don't. Is when these things happen, there typically is going to be more regulation, right? Everyone's going to be asking questions. Oh, could we have done more, you know, as regulators you know, to avoid the situation? What could we have done to catch these issues earlier, to avoid it from coming to a failure situation? So I think for sure there's going to be more regulation. Especially so coming out of the last banking crisis, right? So um, really what happened to banks was exactly the same thing. So we had um, the creation of the whole um, GSIBs, right? So the globally systemically important banks, there's like 30 of them in the world. There's about 8 of them in the US, right? So you think about your big household banking names, they're all sort of, GSIBs. And the regulatory scrutiny that those banks are under is quite significant. Like they have to do some really meaningful, very granular reporting on, their capital situations, their liquidity situations, daily flows of information going from them to, the regulators, so that everyone can be assured that, they are being well managed and they wouldn't run into situations where they fail because, they're deemed as too big to fail. And if they failed, to be more than contagion, it'll have huge ramifications on not just the banking sector, but the entire, economy, right? So they're under a lot of sort of regulatory scrutiny. Now, interestingly, where banks run into trouble is where it comes, in the most recent situations, it's all on a liquidity front. Like, for example, so Silicon Valley Bank, its investments in US Treasuries, that would have been fine if it had been able to hold them to maturity, right? There was nothing wrong with those investments. The only issue is that they had to sell those investments to meet their liquidity needs before maturity. And that's really where they run into trouble. So liquidity is really super important for banks. Now, interestingly, so coming out of the last financial crisis, banks with assets over $250 billion were required to adhere to a certain sort of liquidity ratio and report on that liquidity ratio, to the regulators. Banks with assets below $250 billion didn't have to do that. So all these banks that are in question right now, the regional banks, the mid-sized banks, they're all under that $250 billion threshold. So they never had to do any of this reporting, right? So now there's been a lot of discussion around, should we now expand those liquidity reporting, requirements to some of these sort of mid-size and smaller tier banks? So that's very topical right now, right? And what does that mean for banks? It just means, hey, they have to spend more money on more technology to get to do all the reporting, more people, which costs money, right? So it eats into their profitability. So there's obviously resistance from the banking sector to do this, right? Because it's more costly, it's time consuming. They have to, put systems in place and so forth, right? But if you think about the impact and what it has in terms of stability of the marketplace, that might be something that's forced upon, some of these mid-sized banks that have to try and adhere to, similar to what the larger banks have to go through. So I think, so that's definitely one angle. And I'm sure there's other things that have been explored in terms of how to make the whole system safer, or certainly perceived to be safer, for consumers like us in the banking sector.
Sorry, guys. I lost the connection on my computer, so I rejoined from my phone. So weird. I got kicked out of it. I'm sorry about that. I'm back.
Well, you're back. You're back just in time because I just finished answering your last question. So
okay, good. Sorry.
So on to the next question.
Sure, definitely. So now that we explore a little bit about the background, what led to the event, regulatory impacts, and sort of what are the kind of things that might come out of this from a regulatory perspective. So when we start looking ahead, right, from your personal perspective, how do you go about ensuring that your own deposits were safe during the crisis?
Well, so one thing actually, so I personally didn't actually have to do anything because I'd already done it I'd already kind of structured my affairs in such a way that I wasn't worried, right? Because I talked about the FDIC, essentially guaranteeing deposits up to a certain amount, so $250,000. If you have deposits of up to $250,000, it's insured. If the bank goes under, you will get your money back, right? And so for me personally, so if you have, if you spread your assets around, obviously it's and that insurance limit is per account type, per institution, right? So you can spread your money around maybe a few different banks. And even within the same bank, you can have an account for yourself, you can have an account for your spouse, you can have a joint account. In the same institution, that's counted as 3 different account types, each of them guaranteed up to $250,000, right? So diversifying your asset base across maybe different institutions, different account types, all of a sudden you can see you can build up a pretty hefty insurance amount that more than covers, the cash that, you and I have, sitting in you and I sitting in banks. So I wasn't worried because, I have my, you have these guarantees and you spread your assets around in such a way that, you can take advantage of some of these insurances and assurances that the regulators and the authorities kind of, give to us. And I'll give you one example. So I don't know if anybody follows basketball, but, there's, Giannis Antetokounmpo, right? He gave an interview and he talked about how he's got something like, 10 or 15, bank accounts, spread across different banks. And obviously that's an extreme example and he's got a lot of money, right? So he probably has to do that to make sure that he's able to kind of benefit from the, insurance that's out there. But again, that's an extreme example, but that's, an extreme example of diversification to make sure that you are aware of the guarantees and assurances that you have out there, and you structure your affairs in such a way that you take advantage of them. So that's what I did for myself.
I have a follow-up question about that. So we definitely heard some of the advantages of diversifying, where you like having different accounts to diversify, all your assets. But what could be some of the challenges of having that kind of a strategy, on your personal opinion? I mean, for me, like if I look at it myself, if I were to do that, it would be like a lot just for me to know, okay, where I have stuff, like, you know what I mean? For me, like the tracking part of it, I don't know. I think for me, it would be too much of an admin work to understand like where everything is and then where to put and where not to put, right? So I guess in your opinion, what do you think will be some of the challenges of having that kind of a strategy?
Yeah, so look, I mean, I think, yeah, fine. So there is a drawback of having, the administration of kind of keeping track of your affairs. But again, I mean, for humble individuals like us, we don't have to go that far, right? Because like I said, even with one institution, having, an individual account, a joint account, one for your partner, that already gives you like $750,000 of actually, no, not even that. It gives you $1 million of, because if you have a joint account with somebody, each person in that joint arrangement gets $250,000, insurance from the FDIC, and then you have your individual accounts, and that gives you $1 million, right? Again, wow. I'm not saying I've got, not a lot of us have got $1 million of cash sitting around, right? But again, that's just goes to show, and that's just with one institution. So you don't have to do the Giannis extreme example of having like 10 or 15 different banks. You can do it all, and it's all about understanding the rules and what you have at your disposal, and structuring your affairs in such a way that you can take advantage of the insurances that are available to you, and you can do a lot of it within one institution.
Got it. Yeah. So another question I have, what have been your focus after this, the aftermath of the regional banking crisis?
Yeah, so for me, so like in the introduction, so obviously you and I work in the asset management space, right? So we're not in the bank side of State Street Bank,
Yes.
which is the parent company that we work for. So from an asset management perspective, it's really been, and we're a fiduciary for our clients. So we manage our clients' money, and our clients invest in, a broad base of different securities, right? So really, I mean, the focus has been on, our clients' investments, right? Because some of these banks that failed were in, indexes that our clients' portfolios track. And so same as other asset managers around the world, it's all about, when some of these banks failed, making sure that securities are traded in an orderly fashion. Where some of these failed institutions were being pulled out of indexes and new institutions were being included in the index to replace them. That things were being done in an orderly fashion, and we're being transparent and timely and communicative to our clients to let them know what the implications were for their portfolios and how they were impacted. So from an asset management perspective, again, we're not a bank, right? We manage money on behalf of our clients. So it's really just information flow and making sure that as we're sort of trading in and out of indexes on our clients' behalf, we're doing it in an orderly fashion and making them aware of every step we were taking, what the impact was on their portfolios. And this is widespread across the entire industry, right? It wasn't unique to our organization. All asset managers have to kind of go through this. So now it's really kind of just looking out to what potentially could be next, right? Where the next issue could possibly be, like we've talked about First Republic Bank, being, under watch, and what that could do to the broader marketplace, right? Because you can have, when some of this news comes out, investors, panic, and then you'll see impacts on the broader banking sector, and banking stocks will fall. And, we have to be on a front foot in terms of, advising our clients and what the impact could be on their portfolios and their investments and so forth. So it's really kind of just an eye to what's next. And with my CFO hat on, we talked about, regulation that could be coming down. Again, it's just keeping an eye on, what kind of regulation could come down that could potentially impact my business.
Yes.
And just being on the front foot on being able to anticipate some of these things, so we're ready to comply or add resources that we need to be able to make sure that we comply to any new regulation that comes down the pike.
Oh, this is great. And then I think, along those lines, I remember when you were talking particularly, about the First Republic Bank and, like how some banks gear up together to see how they can help. So on that team, what large companies like State Street Corporation can do to support, the failing financial institution and use their power to provide stability in the market?
Yeah. And so again, so this was all out in the press, right? So, when First Republic Bank, and First Republic Bank is a very big bank, right? So it's like the 14th largest bank in the US. So it's not a small thing. And like I said before, there are 8, GSIBs, right? These are the big banks in the US. And so First Republic Bank is really up there. It's number 14. So we had a consortium of big banks that kind of came together when we started hearing about problems with First Republic, that came together to inject liquidity into First Republic Bank to help it stay solvent, right? And I think they came together and pulled together about $30 billion, collectively among a group of banks. And so that was great. So that was industry participants kind of coming together and helping, some of their counterparts to stay solvent and not to, cause, another failure. And so that's great. And then you had, in Europe, you had UBS that kind of stepped in to buy Credit Suisse, which is a European bank that has had issues for a very long time. This is not a new thing. Like Credit Suisse has had a lot of issues. They've kind of overextended themselves and getting involved in different business lines that haven't necessarily been that profitable. And so they've kind of struggled with their business model. So, UBS kind of stepped in and they took over Credit Suisse, right? And we've had examples over the years of banks kind of stepping in and buying other banks, like Washington Mutual, which was actually that was the biggest banking failure in US history, right? And that happened in sort of 2008, 2009. And then our Silicon Valley Bank is the largest bank failure since Washington Mutual. And then, that happened, and then JP Morgan at that time stepped in and picked up Washington Mutual's assets, looked after their customer base and so forth. So there is history of, industry players kind of, stepping in, and it hasn't always just been the government, stepping in to bail out banks. Other banks have stepped in and helped stabilize, the banking sector. And part of the reason why the U.S. banking sector has gone from 7,000 banks, back in 2007 to what it is now, about 4,800. It's not because they've all failed. Like, we haven't had that many banking failures. It's because there's been consolidation. Bigger banks have bought little banks, to make the platform more stable, and so forth, right? So that's so there's a strong history of the industry kind of coming together and looking after itself.
Great, thank you so much. And then I just want to maybe answer some comments I've seen on the chat from before. So somebody was talking about, when you were talking about diversifying the deposits, different banks. Somebody was talking about like the same bank in different states. So just to clarify, it's per institution. So for example, let's say Bank of America, if you deposit in a Bank of America branch in Boston and you deposit in a Bank of America branch in, or you have an account in a Bank of America branch in New York, it's the same type of account, it's the same institution, just one account, like, like for the insurance purposes, right? Like, it doesn't matter what state your account is, if it's the same type of account.
Exactly. Yeah, it's based on the type of account that you have and the institution, right? So it's so I think there's like 3 criteria. You guys have to look it up yourself. Again, I'm not an expert. I'm just a consumer like you guys, right? But from what I've seen for myself, it's like the type of account, the person who owns the account, and the institution. So in this particular case, if it's the same sort of, checking account with the same bank for you, irrespective of, whether it's with a different branch here and there, I think it's going to be seen as one type, one scenario. But if you have like a savings account and a checking account, that might be viewed as being different. So maybe you have to kind of do the research and talk to your banker about it. Just a quick phone call, just, they'll tell you exactly what's insured and what's not insured.
And then like another like was at the beginning of the chat, because I was reading it. So somebody was talking about, if one bank fails, does that impact the other branches? It's the same. So we're talking about banking failure is the institution as a whole. So like the Boston branch of whatever bank fails, it's the whole institution, like the whole company that fails. So just clarifying that as well. So it's not like a branch by branch, one branch of a bank can close, meaning like they're just gonna close a location, but that doesn't mean the bank is closing, so that's different. So just making sure that's clear, that when we're talking about banking failure, it's the actual institution as a whole, and not irrespective of the different branches that they have. So
correct. It's the whole institution. Yeah.
Great. So we're getting closer to the end here. If anybody has questions, please either raise your hand and you can be unmuted, or you can use the chat feature to ask any questions. I'm just keeping an eye on the chat here. If you see me like poking my phone, just because I'm opening the chat box. So please let me know, and then if you have questions and you want to be unmuted, you can raise your hand and Oscar can unmute you, and then you can take on the line and then ask your question. Okay, so far I don't see any questions. So, oh wait, no, I see something here. Somebody. So somebody's saying, if possible, I would love to hear both speakers take on Credit Suisse and its acquisition by UBS in the moments leading up to its collapse and the commotion around its handling by the Swiss government. So any insights you want to share there, or your view on the Credit Suisse acquisition part?
Yeah, so yeah, look, I mean, I guess it's no secret that Credit Suisse and UBS have been huge rivals in the Swiss banking space for a very long time. And again, just as a participant, I don't particularly think UBS was particularly thrilled to be buying Credit Suisse. I think it's quite clear that wasn't the case. But again, this is an example of regulators strongly recommending actions that banks should take to help stabilize a banking sector. And I talked about those 30 GSIBs. So these are the banks that are too big to fail. Credit Suisse is one of them. In terms of the global banks that are deemed as too big to fail. And you can imagine if Credit Suisse failed, the ramifications across the whole banking sector would have been so significant that we didn't even want to contemplate it, right? So I think from a stability perspective, I think it was the right move. And you can't always have the government stepping in, right? Because it gets into that whole moral hazard sort of territory where it's like the government stepping in to bail out a certain bank, and it's using taxpayers' money, right? Yeah. And so then it impacts non-related sectors, because everyone is having to kind of fund these banks and all these bankers and the rich bankers, and there's all these issues around governments doing that. So it's like almost like a last resort. So to the extent that the government can encourage industry participants to look after themselves, I think it's a win-win, from an overall broader economy standpoint. And there are going to be issues, right, with the merger of two big Swiss giants, or the acquisition of one giant versus by another one. It's going to be difficult, and I won't mince my words about this. I think it's going to be a tricky situation, and we're not going to see how it all plays out for some time to come. But I think it was probably the right thing to do given the circumstances, and it was just too big for the government to kind of step in and bail them out.
Thank you, Apea. And I'm in the same line with Apea. I believe that it was the right thing to do, and I guess for UBS, the right opportunity, because there was a definitely good price. The price they got to purchase that. It was really devaluated so much. I mean, they pay a really, like, the price they pay was way below the value of the bank. But again, it is something to prevent a major global bank to fail, which I couldn't even imagine the results of that if it actually happened. So it's just another way of saying how other peers can save other peers, and how banks can buy other banks to prevent major impact. And in this particular case for Credit Suisse, right, Apea will be a global impact, right? It's not that, it's more than just having like Silicon Valley's bank fail, which is not as large of a footprint. But I think that's a good point around the government not intervening to bail them out, because there's definitely, the first thing is that they're using the taxpayer money to do it. But, sometimes not viewed as nice by the regular citizens like you and I, seeing the government bail out a large company that have more money than we do, and serving people that make more money than we do, and with our own money. So, definitely, the eye of the common people, the common citizen, wouldn't be in the right thing to do, right? So like I think that they were lucky that they managed to get UBS to purchase it. So in the interest of time, we have 2 minutes left, and if there are any other final comments or questions, we're happy to address.
I saw the panelists raise their hands, so I'm gonna let them speak right now.
Okay.
Yeah, their name is Chaya or Chia.
Chaya.
I'm pronouncing it wrong.
Hi,
Yeah.
thank you. Thanks, Oscar. And first of all, such a great event. Thank you so much, Apea and Anthony. My question was more about, I think it was addressed where the news breaks out about banks failing, or anything that has been happening so many times, like the scams, everything. And now with all the AI being everywhere, and I mean, we have seen how Google was showing us with the Chat GPT or AI, how you can create fake news. How concerned should we be if something is going on with the banking industry, if something, even though the news is not real? So any thoughts on that?
Oh, so in terms of, some news breaking and then us being concerned whether it's real or not, or whether it's fake news.
Yeah, I think how what are the risks that people might have, like if you because you see such things because of the technology being used in a wrong way sometimes, and people start to go and withdraw, and for people like us, like who have checking accounts or savings, what are things we need to keep in mind with all these things happening?
Well, I think, well, for starters, right? So again, so when it comes to the banking sector, it's really kind of, as an individual, we've talked about how you can kind of structure your affairs to kind of protect yourself, right? And
Yeah.
there's a whole bunch of guarantees and things that will make you feel more comfortable and not to panic, right? I think the last thing we want to do is panic. So we want to structure your affairs in such a way that you got the right insurances and you're safe, right? And then just as with anything else, you get hear a piece of news, you got to do your research and find out if it's real or not, right? You got to get it from multiple different sources, from sources that you rely on, right? Whether it's Bloomberg or CNN or Fox, whatever it is, whatever sources that you actually is not fake. Just check multiple different sources to make sure that it is real. And then one thing I do personally is, whatever banks I bank with, I check their financial statements. I mean, I'm a CFO of a company. I can read financial statements. I check their balance sheet, and I check some of these things myself. I mean, are they are they a good bank for me to invest my money in, or is there? Because I mean, some of these things that happened with Silicon Valley Bank, there were issues that were there for a long time, and a lot of people saw it, but they just didn't do anything about it, right? So some of these things kind of stare at you, and they're in plain sight. You just have to look. So I think this has kind of created a lot of awareness of some of the issues that there are, potential issues in the sector. So that this should open our eyes, right? And not just blindly follow. Let's check. We're all financial professionals here, I think. And we all have the ability to kind of see, spot some of these things for ourselves.
No, thank you so much.
Thanks for the question, Shai, as well. So we're already open time, and we really appreciate your your time here with us, Apea, and also for the people that joined today during lunchtime and learn and share this learning session with us. I thought there was like one last sort of question. I don't know if you have time, Apea, to take it, something very quick, and I'll just ask because I think it's a good one. So we have Kimberly Mareros. She's asking if as a recent graduate, she's basically entered the job market, like what's some advice that we can give her on how to navigate this time, right? So just so new into getting into financial freedom, like any quick advice you can offer in a minute or so.
So say that again. So how to navigate the current situation, or
yeah, like how navigate this time that we're on as a recent college graduate that just entered the job market, right?
Right. Okay. So if you recently entered the job market, that's wonderful, right? So it means you've got a job, which is absolutely wonderful. So congratulations. Because I think the issue that I guess we're going to see now going forward is, like with First Republic Bank, for example. One of the things that they're doing is they're laying off people, right? So to kind of cut their costs and to manage their P&L and to manage their finances, they want to scale back on their costs. And one of the big areas that a lot of companies do that is to lay off people. So if you've got a job, that's wonderful, right? And obviously we're entering a phase in the economic cycle where things are kind of slowing down a little bit, right? So if you got a job, just obviously hold on to that. That's great. But just with anything else, some of these things tend to be cyclical. There's a lot of news and noise about it right now, but sometimes depending on how things go, they pass and things kind of normalize and they stabilize. So I wouldn't worry too much right now. Let's just keep a close eye on what's going on. But again, in a month or two, everything could have stabilized. I'm not saying it is. I don't have a crystal ball, but things could have stabilized. I wouldn't panic. If you've got a job right now, again, hold on to it. Work hard, do your thing. Congratulations. And things could stabilize in months, weeks, months, years. So I lived through 2007, right? We thought, the whole world was going to come to an end. And it was painful for a long time, but look where we are now.
Thank you. Thanks, Apea, so much for answering the last question. I know we're over time. I want to thank everybody who's here today. Thank you, Apea, and Oscar for hosting this session. And we hope to see you again on future events for the financial literacy program for Alpha Boston. Thank you so much, and have a nice rest of your day.
Thank you.
Thank you very much. Bye.